to share my screen right now because that's one of my slides actually, just to talk a little bit about what I do, and just want to make sure that we're back to the right view. Does the slide look correct?
Perfect.
Perfect. Okay. So yeah, I'll introduce myself in a minute and what I do. But what I'm going to talk about today is I'm going to focus on the use of insurance from risk to wealth. So I know that there's going to be other speakers on the call. So Nick, Simon, JP, and so there will be also, whether it's this session or other sessions, access to accountants and lawyers. And so really where I come in is I'm more on the strategy and the product side. And I work for Canada Life. And so we would be a partner supplier for advisors such as Nick and Simon. So I really appreciate the opportunity to be here, to be invited to be here today. So I am based in Halifax. So I'm coming at you live from my home office in Halifax. And what I do is I work with advisors like Nick. So Nick is also here in the Halifax area. And I focus on what we would consider to be large cases. So large cases would be premiums of $15,000 of premium per year or more. And I focus exclusively on those. So when you're getting into those larger premiums, really, you're thinking beyond risk management. You're often actually thinking about things like estate planning, tax deferral, other purposes and other uses for insurance, but that's exclusively what I deal with. I have been with the company for 25 years. I worked in other areas with living benefits, which I'll touch on a little bit later, and also your more kind of traditional and basic life insurance sales. So I can field questions about that as well. So just to give a little rundown of some of the things that I want to talk about today, and really this is your time. So if there's something that you want to talk about, I'd love to hear a question. We can answer those all at the end. And if it's something that I can't answer, I have colleagues who I'm sure can. One thing I should mention is that one of the people on our team locally, I work with somebody who is he is a CPA, and he works exclusively also with what we would call those larger premium cases. Just a side note, he's on an adventure trail run today. So he's in rural Nova Scotia, running up a mountain, and so I'm here and he's not. I'd rather be doing this, to be honest. So I'll talk a little bit about the market. I'll talk about the financial planning process, bit of a solution overview. So think strategies, and we will talk a bit about leveraging. That's a hot topic. So using insurance as a stream of income, and then we're also going to talk about a product that is unique to Canada Life and really fits well within the market, so within the group that we're talking about or talking to today. So I wanted to show you this number. So the reason I wanted to show you this is this would be last year what Canada Life sold in what we would call larger premiums, so $10,000 of premium or more. And the only reason I'm showing you this is sometimes when people talk about strategies or ideas, I'm left wondering, do people really do that? Do people really put these strategies in place? And you wonder kind of how real it is. And so, do people do this? And the fact is, yes, people absolutely do this. So the bulk of people who would be buying these larger policies would be professionals like yourselves. Doctors, dentists would be probably the predominant buyers within the professional marketplace. The other group would be largely business owners. So that could be really in any industry. We also deal sometimes with high net worth families, but almost all of the time that money is generated from being self-employed. So it's almost exclusively income generated from being self-employed. So I wanted to mention process. And so Nick and I talked about this earlier this week because I wanted to make sure that the way I think of things is in line with the way that he's thinking about things. And so I said, how would you describe your process? And this is what I would consider to be a really kind of solid start to finish sales process where you're really addressing what you as the client needs and what you as a client wants, and not just selling a solution. So really, when you're sitting down and talking to somebody, ideally just like you as a physician, you're going to try to figure out what's wrong before you make a diagnosis or before you prescribe something. That's really what your planner should do as well. So that can only happen if they ask you questions. If they start with a solution, that's not necessarily going to fit what they need. So that whole information gathering, overall snapshot of your full financial picture, then going out and building that solution that's really tailored for you. Meeting and presenting and doing a pulse check, seeing if this is in line with what you're thinking, because some of this is numbers, but some of this is also just what your goals are. And that can also only come forward by being asked the right questions. And then the key thing is delivery and implementation. So having been in the industry for a long time, I would say that one of the things that the really successful advisors do, and the people who you want working for you, is they don't focus so much on, I'm going to get you the best rate of return. They focus on what kind of, how can I get you to do the right things? How can I get you to take action, to start doing the right things, to stay the course? And that's a big one, just to stay the course, but also know that circumstances change, and build a plan that can change with you. So really all that to say that ideally what you're looking for is an integrated wealth planner. Also look at your plan as it's a living plan. It's something that's going to change as your circumstances change. And that's why it's important to look at a plan and to make sure that you're in communication with your advisor to make sure that it's accommodating for any changes that you've had. So one thing I did ask Nick is I said, how do you feel about the client or the advisor who has an advisor already and who's done a really good job? And so some of the strategies maybe that we're going to talk about today haven't been presented, but you might be happy with your planner from a wealth perspective. And so, are you okay with, or is it acceptable to do more of a kind of a strategy or a tactical type of a planning sale? And so I would say that, most advisors are. Nick said yes, absolutely, but still knowing that it fits your situation. So maybe you're going to deal with more than one person. You're going to have your accountant, your lawyer, your wealth planner, your insurance advisor, but still making sure that each of those people has an overview of the entire situation. So when we think of insurance, this is I use this slide kind of on a regular basis, partially because this is really how I think of insurance myself in my own mind. And so when people say insurance, most people immediately go to the left-hand side of this slide. They go to the immediate needs and income replacement, because traditionally that's where insurance has focused. That's what most people buy it for. So when you think of yourself as really an income generator, so you have somebody who's 30 years old, maybe they're going to work until they're 65. How much income can they generate over that 35-year period? That's what you're insuring with income replacement. You're insuring up to that amount. You're insuring debts, either in your business or personally. You want to make sure that your kids can go to university, whether something happens to you or not. So you're really thinking about those pure needs-based risk management issues that you may have, and things like income replacement. But then as you move along, insurance can also be used for lots of other things. Insurance can be used for tax planning, tax deferral, succession planning in a business. It can help you leave a legacy. So it could be in your community. It could be just leaving your family in the best position possible. And it could be about preserving your estate. So that's something that we see a lot, is someone builds something and they think it's enough. They think, I've built this huge business. I'm leaving my family enough. But just because they maybe don't want to leave more doesn't mean that they're okay with what they've built being eroded, which is what can happen with tax. So at minimum, people tend to want to protect their income potential and preserve their wealth. So term insurance. So even though I'm going to focus more on what I would call the permanent insurance solution, I did want to talk about term, because I know that there's different people on the call who are at different phases of their financial planning life cycle. So if there's anyone on the call who is just newly out of school and maybe has, a couple $100,000 of student debt, they're hoping to buy a new house, you're in a position right now where really it's about buying a volume of insurance. Again, it's protecting your earnings capacity, your human capital, and that's where the focus should be. So some of these ideas are good, but they might not be for you right now. Then at the other end of it, you could have somebody who's 45, 50, 55, and they have surplus in their company, and they're looking for different strategies and different places to put some of that money. And that's where some of these ideas can come into play. So it's, again, it's a plan. So if it's not for you today, maybe it's for next year, or maybe it's a plan for the next decade, depending on where you are. The good thing about term insurance is it does protect the risk. It also allows you to be medically underwritten now. So when you buy a term policy, think of it almost like a placeholder. It's allowing you to be protected now and to execute some of these strategies later without having to answer any health questions. You do have to look at the terms of the contract, but generally that's how term insurance works. The challenge with term, why it's not a good long-term solution, is sometimes some of your needs are going to be long-term. So term will expire. It will go up in price in most cases, depending on the term you've purchased. So you do want to make sure that you address some of those longer term needs with more of a long-term product. It also typically expires, as I mentioned, at 85, but even before that, sometimes the renewal costs are so huge that people will just let the policy terminate because it can become very costly. And like I said, and actually I put it in the wrong spot, it's medically underwritten at the time of application. So that's actually a positive thing for term. As I mentioned, I'm just going to touch on living benefits. So this is something, especially, I would say during your entire career, but even more important while you're building, while you have debt, but really up until retirement, is looking at living benefits as well. So when I think of insurance, I think of, again, risk management planning as the primary thing that you have to take care of. So if somebody is sitting there with a finite number of dollars that they're able to use for insurance, I would say step number one is buy a bunch of term, buy critical illness, buy disability insurance, get that taken care of. And then if there's more money available, more premium dollars, maybe more money in your corp, then you can redirect some of those dollars into a different type of insurance policy. But this is where to start with the risk management. Okay, so I want to switch gears kind of more into what we wanted to focus on today, which is we're going to work a little bit under the assumption we're going to talk about strategies for those individuals who are in a position where there is some money, there is some excess money, there is some surplus, and then therefore they have the capacity to execute on some of these strategies. Now, this is a corporate version, and all of the versions I'm using are corporate. I realize there might be some people on the call who are not incorporated. That's okay, because the same strategy can be used on an individual basis. There are some differences. There's some elements. You're using obviously individual dollars versus corporate dollars. There's a few things that don't apply on the individual side, but the overall concept is the same. So just remember that we can do this personally, not just corporately. So just a very high level on how money is taxed in a corp, and what we're trying to kind of get at here today is if you have an investment in your corp, there's going to be tax on that investment in your corp. And if it's a passive asset, it's going to be taxed at the highest passive rate. And there's people from different provinces here, so I didn't really get into a lot of tax rates because there is going to be a variation from province to province. Any numbers I ran using Nova Scotia rates. Then what happens is the money grows, but then if it gets passed along, there's going to be tax payable at that time as well. So there's kind of double tax along the way. So if the money if there's some excess money there that doesn't need to be used, and it is growing, the idea of putting it into a different vehicle is something that should be considered. So if we look to the right-hand side, if you put the money in an insurance policy, the growth in the insurance policy, so now I'm talking about the cash value in the insurance policy, it's going to grow on a tax-deferred basis. So there's going to be no tax along the way. And then what happens is with insurance, and the insurance policy, whether it's corporately owned or individually owned, the benefit is always paid out tax-free. So you've redirected this money you were going to pay a bunch of tax on, and instead you've put it in an environment where it can grow tax-free. And then when it passes along tax-free. Now, does 100% of the value come out of your company tax-free? Depending on the year, depending on when you pass away, most or all of it can be taken out tax-free, because insurance creates what we call capital dividend account credit. And I'll mention a little bit more about that in a minute. Now, the other thing to think about is somebody might be sitting here and going, you know what? I'm 40 years old, 35 years old, 45 years old. And the person might be thinking, you know, I don't know if I'm in a position right now to think about what I'm leaving my family. Maybe I don't even have children yet. And so what we are also going to talk about is the value that you're building up in this policy can be used as a living benefit. There are ways to tap into some of that value in your policy if you want to, if you need to, and we'll talk about that a little bit as well. So just back to the corporation. So an example of, as I mentioned, when it's in the corp, it's going to get taxed along the way, and then it's going to get taxed at the end when it's withdrawn. So this is an example. So just imagine somebody who has $250,000 in their corp, and they're adding $50,000 a year to their corp for 15 years. So this has nothing to do with insurance at this point. This is just what's going to happen to that investment. So that person has invested $1 million over this 15-year period, and pre-tax, in the magical land where there's no tax, this would have grown to about $3.3 million. But in reality, you do have to pay tax, again, along the way and at the end. And so because of the erosion of tax, the person isn't really left with 3.3 million. They're going to be left with more like 1.2 million. And so I always think, one thing I think about this whole concept is, when you do nothing, it is a decision to be made. There is something happening, because I think a lot of the time people think, well, if I just keep doing what I'm doing, I'm going to go from the million to the 3.3 million, and don't factor in what happens along the way because of the erosion due to tax. So is this you? So do you have money in your corporation, and do you have annual tax obligations from those investments? Maybe you haven't considered the impact of tax. You've just kind of turned a blind eye to it. And obviously it's comforting to have money in your corp. That's great. We're not suggesting ever that you take all of the money and invest it in an insurance policy, but it is the idea of looking at what is happening to that money, and it could be redeployed in a way that has a more favorable outcome for you. Also, people who are looking at different strategies. So to me, I think the financial planning kind of like different buckets. So you look at your corp, you look at TFSAs, RSPs, insurance, all different types of funds. And so it's just about picking a combination of things that are best going to accomplish what you want to accomplish. I think another key point is seeing the value in insurance. So, and people will probably argue with me about this, but I find when people try to position an insurance policy and compare it to an investment exclusively and not talk about the benefit of the insurance, you're really overlooking one of the most compelling things about it. The fact that you've got this instant estate creation. So from the day you pay your first premium, you immediately have that death benefit associated with your policy. To me, that's very compelling. And then again, you get this tax-free benefit at the end. So if you only look at the investment component and compare it to an alternative investment, you're kind of losing out on some of those key points. So really this works best when somebody appreciates all of the elements, the whole package, the insurance at the beginning, the insurance at the end, and then the investment along the way. Okay, so I mentioned a couple of slides ago that I was going to mention the capital dividend account, and I'll admit I put this in at the last minute. I was going to leave it out because I thought, oh, this might be getting a bit too much, but it's really compelling. So anybody who is incorporated here and who has met with their accountant, they may have heard about this before. So, but if not, I just wanted to give you kind of high level what it is. So what it does is it allows you to withdraw company money without paying any taxes. So if you have capital dividend account credit, you can take out some money tax-free. But there's only certain things that create CDA. We call it CDA. There's only certain things that create CDA. And so things that do create CDA would be things like dividends received from another company, gains and losses on certain assets, but also the proceeds of a life insurance policy. So when I mentioned that that benefit's going to flow into your corp tax-free, the reason why you can pull most of that money out tax-free is because the insurance created CDA credit. It created the CDA credit, and now you can use it to take out the insurance tax-free. What's really interesting though is, let's say you buy an insurance policy for a purpose. Maybe it's for a corporate loan, for an office. Something happens, the money comes into the corp and it's used for its intended purpose, which is to maybe pay off a loan or pay the rent. Even if you, in those cases, you wouldn't have had to use any of that CDA credit that that insurance policy generated, that's still going to sit there and it's available to be used for other dollars in the corporation. So the CDA that's created by an insurance policy isn't specifically tied to those exact dollars. You can use it for other dollars. So sometimes people use insurance purely for, they call it CDA planning. They buy the insurance because they have dollars that they want to be able to take out tax-free. And an insurance benefit is going to be able to free up those, create that CDA and free up those dollars. So if you have that problem where this is a good problem, by the way. If you have that problem where you have money in your corp and you're not sure where to put it and how to position it, can insurance be the solution? So one thing is, it's a tax advantage way to transfer assets from a corporation. Like we just talked about, you're going to have the benefit of CDA with the death benefit. We have a tool, and I'm going to show you some of the output of that tool, and it will show you how taxes can erode wealth. We talked about that a few slides ago as well with the tax grind. We can show you how life insurance can have an advantage over alternative investments. And we can show you a comparison on a specific scenario as to how insurance compares to investments. Because that's a very common question that we get, and it's a really good question to be asked, which is, if I redeploy this somewhere else, how will it do comparably? You always want to look at, if I take that dollar and do something else with it, how is it going to perform in that something else? How is it going to perform in that other investment versus how is it going to perform in the insurance solution? So the person who this is suitable for, this particular strategy, is somebody who is generally generating more wealth than they need to for their day-to-day operations. So there is money there. Generally, I would say somewhat risk averse. That's not necessarily always the case. The other way you could position this or think about this is, hey, I'm actually, I am a risky advisor. I like Bitcoin. I like equities. And if you're that person, the other way to look at this is the very conservative element of your portfolio. So saying, okay, you know what, I'm going to be risky with this percentage, but I'm going to be really safe with this percentage, and using insurance as that kind of like fixed income alternative. The other thing is, this can be used, as I mentioned, you might be at a place in your career or just based on age where you're not really able to think about legacy. You're not thinking about what happens, you know, when I'm gone 30 years from now. You're thinking more about what happens between now, my retirement, and then my legacy. But you need to think about yourself. So again, you need to think about the insurance as possibly generating some income for you in your retirement. So I want to use an example, and I realize with physicians, there are dramatically different incomes depending on where you are and depending on your specialty. And so I used I changed a few details slightly, but you know, I kind of used what I would consider to be a real life example. And so Jane is 50, she's married. She has 2 children, teenagers. She's on the board of a local hospital, and each year the following typically occurs. She's paid, her corp is paid $650,000. She nets out 500 after her expenses, and then a dividend is paid to her for $350,000. So, and I didn't include all of the assumptions, and this is the type of thing that your planner, somebody like something that Nick would be able to do for you, which is come up with, use your real examples, your assumptions, your province, and determine these values. So again, these are just kind of ballpark, but what we did is said, okay, the estate shows a tax bill, or I'm sorry, a total value that's going to have a tax bill associated with that. So she's in a position right now where she has about $150,000 of, you know, surplus, excess, not value in her company that's not required. She's going to have projected to have a tax bill of $750,000 at death, at life expectancy. So potential solution is corporate life insurance. So one thing, just kind of as an analogy, one thing that we talk about sometimes is the goalposts. You could say bookends, you could say a continuum, but think of it as a range. There's not really one set solution. There's not one cookie cutter approach, but what would be almost the minimum solution would be one end of the goalpost, and what would be a more robust solution would be at the other end. So if we look here, we've said, okay, she has a terminal tax liability, a projected tax liability of about $750,000. So what could we do? What we could do is that we could use that as the starting point and say, you know what, if this is me, I want, at minimum, I want to protect that. I want to protect my estate. I want to make sure that my estate's taken care of. So we could offer you a solution for the $750,000. The other thing that you can do, though, is when you buy a policy, you can address other needs. There's other things that you can incorporate into that same solution. So if we look at the first one, I just have to move my screen a little bit. So if we look at Jane, so again, she's 50 right now. If we look at her when she is 85, and we say, you know what, we're just going to take care of that tax liability. Well, what does that look like? So this is just one solution, and there's a lot of different ways that you can build something, but this particular solution was very much built on taking care of that problem. So what I used a permanent insurance policy. So this is a permanent policy, meaning that it's going to cover you forever and it's not going to change in price. And so what I did is I built it in such a way where approximately at age 85, she would be left with just the right amount of money to cover off her projected tax bill. So the way that it's built is it would start at $575,000 as a death benefit, and then it would grow, the projected growth over time would bring it up to about $775,000. Now, we don't know when someone's going to pass away. So we do always keep that in mind, is it could happen earlier, it could happen later. We really don't know. So we have to make sure that we provide a solution that is good regardless. Also, I should mention that the solutions that I've put together here are single life solutions, and it is possible, and we can maybe talk about this during the Q&A, it is possible to do what's called a joint last to die scenario. So I mentioned here that Dr. Smith, she's married. So what happens is a lot of these tax issues that you're going to run into, they're not, if she passes away first, you don't really have a problem. When you have a problem is when her husband passes away. And that's when the liability is going to come into play. So arguably, the other thing you could do is it is actually more efficient, is you could cover both of them on what we call a joint last to die policy. And what it does is it combines both of them into one policy, and it pays out when the second person passes. So it comes in, at the right time. We do a lot of joint last to die. We also do a lot of single life, because somebody sometimes people say, well, I get that, but I'd like to take care of the problem here. And I also want to make sure that I get the benefit now if something happens to me. So in other words, they're not just thinking about estate planning, they're also thinking about providing some protection in the shorter term. So now if we think more, let's think more in terms of right goalpost. So we've used the insurance, we've taken care of a problem, that's cool. And what was the price? 800, yeah, let's round up $8,900 a year to take care of the problem. So then the other thing though, is we said, you know, based on what we were talking about before, there's a lot more that insurance can do. Sure, it can take care of the terminal tax liability, but it can also be a place where you put your surplus, where you put money that can be tax deferred. You can maximize the death benefit. You don't have to be confined to just what the tax bill is. So let's look at another solution. And so what I did here is I said, okay, let's pick a solution that has a similar starting death benefit, but it is quite different in the way that it's built. So you'll notice, first of all, the premium is quite different. It went from $8,900 to $33,000. But what you'll also notice is a significantly higher payout at death. So this policy is going to grow much more rapidly. It's also going to create much more capital dividend account credit, and therefore it's going to give you a much higher net estate value. The other thing is, you'll note that the cumulative out of pocket is about $333,000. So this policy is only paid for 10 years. So the other policy is probably going to have to be paid forever, because it's almost like you're just buying insurance, and you're not really building a lot of value in the plan. Whereas this one, you are building a lot of value. And so because there's a lot of value in the plan, it will get to a point where it will self-fund, or it should get to a point where it will self-fund. The other thing about this solution is that part of the premium, part of that $33,000 doesn't have to be paid every year. So there's flexibility built into this. So if someone says, you know what, I have unexpected expenses this year, they don't actually have to pay the full $33,000. So that's another thing to keep in mind, is that part of the solution is coming up with a plan that not only does more things in terms of tax deferral or more death benefit, but also can address what you think are important, such as the ability to stop paying, or the ability to be flexible with your premium and how much you have to pay. So if we look here, and I realize these numbers are a teeny bit on the teeny side. So if we go back to kind of the beginning when we were talking about the tax grind, this is just a different way to look at the tax grind, and talking about how that money would grow in a non-tax deferred vehicle versus insurance being a tax deferred vehicle. And then we've added on another layer here where we talk about the difference, the net outcome at the end of the day, to put those same dollars in insurance as opposed to just leaving them in your corp. And it's a dramatically different outcome for your estate. One number that I really like is the cost per dollar. So what this does is I just think it's a great way to boil everything down and say, if I want to put $1 in my beneficiary's pocket or in a shareholder's pocket, how much is it going to cost me? And with insurance, it's going to be 27 cents. Whereas with an investment, it was going to take 85 cents. You're going to have to take 85 cents and invest it to give somebody $1. Whereas with the insurance, it was only going to cost you 27 cents. And these are really easy to customize for you as an individual, for your exact situation, to see all of these values. So here, same information, just a little different visually. Might have to hit zoom on your screen. But really the main thing to take away here is this line graph. And what we're looking at here is this darker graph on top. This is the death benefit. The dotted line is the cash value in the policy. And then the blue line here is the alternative investment. And so depending on what type of policy you buy, how old you are. So if you think of somebody who was maybe older, who had a medical rating, Maybe the person smoked. These lines aren't going to look as nice. I'll admit that they're going to look a little bit more scrunched together because the insurance is going to cost more. But here we have a standard 50-year-old female. The values are going to be very compelling, and the values are compelling for a long time. Sometimes I do hear somebody might say, "Oh, my client is 65. I think their, insurance doesn't make any sense anymore." It does make sense. It still does if the person's insurable. So don't discount yourself based on age. Also, if you have any concerns about your own health, the other thing we can do is we have an entire medical team. So we have a medical board. We have doctors that we can talk to. And so before somebody even applies for insurance, we have the ability to get a preliminary underwriting opinion to find out if the person's going to be rated. You still have to apply for the insurance, but it does give you a really good idea of whether or not it makes sense to proceed. And then this graph, what this is showing, same numbers, so same scenario, but it's saying, okay, if I wanted to get the same outcome from other investments, what kind of deposit would I need to make into other investments to get the same outcome at age 85 to my estate? And that's what this is showing on the left. On the right, it's saying, what kind of rate of return would I need to get on those investments to get the same net outcome at the end of the day? And you can see it's pretty compelling how much lower a required rate or how much, higher a required rate of return is from those alternative investments. So just kind of back to the concept of we went from one end of the goal to the other with different solutions. And we have lots of tools and strategies we can use. Something I do on a daily basis is I run comparisons for financial advisors. So we can really hone in on what's optimal for you as the client, and keeping in mind, again, your priorities as well as your needs. So the next thing I wanted to mention was about the value in this policy. So a really obvious question is, hey, what if I need this money? So I'm paying all this money, I have excess now, who knows what 10 years, 20, 30 years will bring. Do I have access to this? And so when we run an insurance illustration, we can see the projected values at any given year. And so just as an example, this is the same scenario. So the same person paying $33,000 a year for 10 years. At year 20, I said, okay, she's 70 years old now. What if she wants to access some of the value in her plan? And so in this case, the value is, there's projected to be about $558,000 in her policy. Can I access this value? And the answer is yes. So one thing that I see is I see people present this idea as something that is going to be part of their financial plan. They fully intend to leverage their policy and take an income stream. I would say more often what I would see is somebody who just wants to know that they have access to it, but in reality, they have other assets, they have other investments, and that's really what's going to bring them through their retirement. And this is probably never going to be touched. This is going to be their estate plan. So when it comes to accessing value, there are different ways that you can access value. And it can be done as a one-time payment, or it can be done as a series of cash withdrawals. So you could do it in, for example, you could say, I want to give my adult child a down payment for a house, or I want to pay off their student loan. So you could do it like that, a one-time payment. Or what you could do is you could say, I'm just going to draw pieces of the value out, let's say on an annual basis, to supplement my retirement income. So you can do it either way. So how do you do this? So there's different ways to access the value in your policy. One is a policy loan, where you're actually borrowing from the insurance company. So you would be borrowing from Canada Life. The other is a partial surrender. So some of these policies get really, really big. And you might get to a point and go, oh, you know what? I don't really need the $8 million face amount that I have. I need 4. So what you can do is if you essentially you're like terminating portions of your contract and taking the associated cash value. The other one that gets talked about a lot is, we call it collateral loan, but it's what it is it's borrowing from a third party. So it's, imagine taking your insurance policy that has all of this cash value in it, going to a lender, going to a bank, for example, and saying, I would like to assign this policy and then get a line of credit. And that's what you're going to use to generate income. Lenders tend to really like participating whole life insurance because of vesting. Because with participating whole life, when the dividend gets declared into the policy, it cannot be taken away. We don't guarantee what next year's dividend is going to be or the following year's dividend, but once the dividend is in the policy, it's there, it's locked in. And because of that, lenders really like it because they don't have to worry about market volatility. Okay, so I have just one more thing I quickly want to talk about, and then we can get to questions. We recently launched a product, and it's called MyParGift. And I think that for you as physicians, this is something that you might be interested in, or at least even just keep it in the back of your mind. If it's not the right time now, it could be the right time later. And really what it is it's a charitable giving product. So with life insurance, you can have even just a regular policy, let's say you have own a policy right now, you could either transfer the ownership to a charity, a nonprofit right now, or you could make them the beneficiary. And depending on how you set it up, you'll get a tax receipt. You'll either get a tax receipt now or a tax receipt later. The challenge we've always had with life insurance is, and using it for charitable giving, is there's always that ongoing commitment. With any life insurance policy, you can't pay for it, other than this one, you can't pay for it with one premium. And that's because of the tax exempt rules. So what we realized was, hey, this is for a nonprofit, this is for a charity, the tax exempt rules don't matter. So can't we create a one pay product? And that's what we did. So it's a truly innovative product where we're you're paying one premium to get a face amount that you're going to give to your charity. Because of that, it's very simple. And so that's another thing that's great about it, is just the simplicity of being able to make that one payment and give it to the charity. We've talked to a lot of charities. The one thing I would say is you really have to be mindful of the charity or the nonprofit that you're supporting, because if it's some charities aren't able to think that far out. They're not able to think about, oh, what I'd like to get this benefit in 10 or 20 or 30 years. They need the money now. Or really any charity isn't going to want you to take away your current donation for this year to pay for something that might pay out 30 years from now. So there's different ways that we can make sure that we're hitting, first of all, the right charity, the right nonprofit. So the bigger charities like a university, like a hospital, like the national organizations, such as the Cancer Society, who do have the ability to think longer term. And then we can also build the product in a way where they can access some of the value in the shorter term. So this is just something to keep in mind, is that if this is part of your plan to give, that this is a truly unique and innovative way to do it. So that's what I wanted to talk about today. And so now, Dr. Tran, if there's any questions, I'd be happy to field those.
Yeah, thank you very much, Andrea. Yes, there is one question, but I think you've addressed it, but I think there are more details we can talk about. Okay. Please expand on how to use this money for retirement, which is what you just described there, the loans and the third party, and not only at death or estate purposes. Thank you. So, you know, yeah. a lot of the comments is, I'm doing all this and the only person enjoying it are my children and my estate.
Right.
So how can I enjoy this now as I'm still living? So I guess that's where the question comes from. So
Sure.
can you maybe just elaborate on that?
Yeah, for sure. So one thing I would say is if you don't need to spend the money, or if you think you're going to have access, just kind of be aware that life insurance is the thing that's going to pass along the most efficiently. So if you realize, you know what, I am going to leave something behind, I would say don't leverage your insurance because it's the thing that's going to pass along the best. However, you might say, well, really, I have all my investments, I'm going to spend those. I have all this value in my insurance. And like you said, I'm going to leave it all for my kids, but I would like to tap into that. I would like to supplement my income. So when we go back to this slide, so really there's the three ways. So the policy loan and the partial surrender, those are both directly with Canada Life. But not always in some cases are the best way. You really have to look at the time what the best solution is, because there's different tax implications depending on how you pull the money out. But the advantage of taking out a loan or doing a partial surrender is there's no credit checking at all. So for example, if this client, I go back to this, if this person had this policy and they talked to their advisor or they called client service and they said, I want $250,000 because I want to do a renovation on my house, we will give them the $250,000. They don't have to fill out a credit check form, nothing like that, because we can see that the value is there. If it's a loan, the policy is maintained and the loan is kind of separate from it. So they have the ability that if they want to repay it, they can repay it and the policy still stays intact. On the other hand, if they said, you know what, I really don't need that death benefit. Right now, I'd like to take the $250,000, but I also don't need that $1.2 million death benefit. The other thing they can do is they could just cancel a portion of their insurance and take a proportionate amount of value out. So all that to say that those are what I would call the easy ways, maybe not the most tax efficient ways. The other way I mentioned was the collateral loan. And that's when you go to your current bank. There's a couple of lenders out there who do a really good job borrowing against insurance or lending against insurance because they're very proficient with how insurance works. So they always have very competitive terms. And that would be, for example, Manu Bank. And there's a bank called EQ Bank. And they have actual lending programs. So they can tell you what the current terms are if you wanted to assign your policy. The thing to be mindful of there is that it is a credit process. Even though they see the value in the contract, they are going to do a credit check on some level for you.
Thank you, Andrea. I think it's the collateral loan borrowing from a third party or is at least in my mind, it's a really attractive solution because the loan that you get, it's a line of credit or it could be even a loan, because it is a loan, is not taxed, right? So you access capital without being taxed at that point, which is, I think, another attractiveness to it.
Yeah, and there's different ways to set it up. So if it's just to make it really kind of a simple example would be if it's personal, so just not thinking about corporate at the moment, you might be able to go to your lender. Let's say you deal with BMO. You might be able to go to BMO and say, hey, I'd like a $250,000 line of credit. And you forget about the insurance. You might be in a position where you can get that already. And you can do that. And if you get that line of credit, it's going to be just a line of credit that you tap into when you want to. There's no tax because you're using after-tax dollars. Or the lender might require that you assign the policy. So you assign the policy and that's your collateral. And the same thing happens. You get a line of credit and it's a line of credit. So there's no tax. So you might be in situations where you don't need to, but in some situations you're going to get to a volume where the insurance is required as collateral. The other thing is there's some more complex strategies that involve things like using a guarantor fee, so taking a corporate asset and using it to guarantee a personal line of credit. That requires an accountant and a lawyer to make sure that it's set up properly, but that's an option. That's an option as well. So the best thing to do is at the time explore what options there are.
So I have two more questions. One is quick. The other one is not as quick, but very, very interesting. So I'll go with the quick question first.
Okay.
What is a typical interest rate for a third-party line of credit leverage against the cash surrender value of a policy relative to the prime lending rate?
That's a good question. So we were quoting because this is what was real. Last year was like 3.5%, 4%. Now when we quote, when we do a strategy, we will use more around 6.5%. Now the thing is, that's now, and a lot of the time when I'm involved on something that's not going to happen now, right? It's something that's going to happen in 10 years or 20 years. So I'm putting together a strategy. But if you went to a lender now, for example, Manu Bank, they had said a couple of, probably even in the last month, that they were, using around 6.5% was what they were comfortable with. It does depend on the individual. It depends on the individual's credit, but that's something, and we don't want to use, if we use really low interest rates, the insurance is going to be more compelling. We don't want to do that. We want to make sure things are realistic so that we're not over promising and then under delivering in the end.
Thank you. I've got two more questions. I said two earlier, but I've got another one, but these are very interesting questions. Please discuss the advantage or disadvantage of a policy built upon accelerated payments of premiums. So for example, a 20 pay that is now paid up in 5 years. What is advantage of that or disadvantage of that?
Yeah, so that's a really common thing to do. So to do that, there's two things that you need to, or there's two ways that could be done. So it almost certainly would have what we call additional deposit option. That's what Canada Life calls it, additional deposit option. And what it is it's essentially paying the difference between the basic premium of the policy and what CRA would allow that same policy to have. So there's this gap. And so if you pay that extra gap, you're kind of overfunding your contract. Really what you're doing is you're taking advantage of that unused room. The advantage of that is the money gets in faster and you can stop paying sooner. So one thing people like to do is, like, depending on their age and their current situation, if they have a lot of money that they would like to get into the contract sooner than later, they'll do that. They'll try to accelerate their premium payments because they're in a position to do so. And then they think, hey, you know what, I'm going to maybe retire in 5 years or 7 years. So I'd really like to kind of get this over with sooner. The other thing you can do is you can add on a term rider, and where the term rider frees up even more of that additional deposit option room, and you can pay even more into your policy. So if you were to kind of boil down the advantages, it would be money in faster, able to stop sooner. I do find that sometimes people use that strategy, but they don't actually only want to pay for 5 years. They just want to get a bunch of money in sooner, but they might be on more of a 10-year premium schedule.
Great, thank you. So this is the nice thing about insurance policies is it's always customizable, and
Yes.
there are always ways to increase that MTAR.
Yeah, absolutely.
So I'll give one more last question because we're beyond our time for this topic. But this is a very good question. So we have a very young physician in our group. As you can see, I have white hair already, so most of us have white hair, but we have a very young physician who says, I'm currently 31 and with 1 year old incorporation. When is this a good time to do it? When should people set up something like this?
I would say when you're comfortable with the surplus in your corp. So I would say the starting point would be taking care of the risk, making sure you have your disability, critical illness, life insurance, even if the life insurance is just term insurance. And then once you feel comfortable that there is some surplus there, then considering moving some of that term, and you can do this without applying for new coverage. You can just do a conversion. You can convert some of that term into permanent. We always want to make sure that the amount of premium is comfortable. You don't want somebody to be uncomfortable with the premium amount, because this works when you stay the course. You have to kind of get on this path and stay the course. And if you can't, it can be you pay one premium, it can be the worst investment. So you do want to make sure that you're comfortable. So I would say once you're comfortable with the amount and you have all of your risk taken care of, then the other thing to consider is sooner is better, because you're getting the advantage of younger rates on the insurance. So when you buy as a 31-year-old, the values are going to look remarkably better at, say, age 60 versus the client that we used here, and she was 50. So yeah, when you can, as early as you can, but when it's comfortable.
Thank you. And that's a good point, Andrea. We didn't really dive into term policies, but insurance is an amazing asset. And we should prepare ourselves for the curveballs that present to us in life. So thank you very much, Andrea, for sharing that with us. I'm going to end the discussion here for this particular topic. There is one question that I'm going to maybe put you on the chat privately, and you can answer it now, and I'll post it up to the group afterwards. Okay?
Sure.
Thank you very much, Andrea.
Okay. Thank you, everybody, for your time and attention. And thanks again for the invitation.